Hi, everyone. Welcome to the next installment of Charts in Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for Vetify. Today, we're going to look at our monthly update on the latest FINRA margin debt data. To begin, let's briefly discuss what margin debt is. So, margin debt is the amount of money an investor borrows from their broker via a margin account. It allows an investor to borrow part of the initial capital from a broker to purchase securities instead of having to buy it from their own savings. Trading with margin debt can magnify gains because an investor can benefit from the upside of any stock without having to invest 100%, resulting in greater profit. However, on the flip side, trading with margin debt can also exacerbate losses because if the stock's value were to depreciate, the investor may face a margin call and would need to come up with additional cash to reach the minimum requirement. So, FINRA recently released new data for margin debt, now available through April. So, let's dive into the charts. First, let's examine the numbers and study the relationship between margin debt and the market, where we're going to use the S&P 500 as a surrogate for the latter. This first chart here shows the two series in real terms. So they're adjusted for inflation using the consumer price index as the deflator. We have margin debt represented by the purple line and the real monthly closing values for the S&P 500 as the green line. At the 1997 start date, we were well into the boomer bull market that began in the early 80s and approaching the start of the tech bubble. The astonishing surge in leverage in late 1999 peaked in March 2000, and the market hit its highest monthly close 5 months later in August. Over the next few years, both debt and the market declined, with both reaching a trough in September 2002. A similar surge then began in 2006, where margin debt peaked in July 2007, just 3 months before the market peak in October. But again, over the next few years, both debt and the market declined. Margin debt hit a trough in February 2009, the same month that the market hit a bottom. Then began another major cycle of increases. We saw a similar surge to the two just discussed, most recently after the COVID pandemic. Margin debt peaked in October 2021, 2 months before the market's real all-time high reached in December 2021. In the latest data provided by FINRA, we saw that the debt level fell for the first time in 6 months to $775.46 billion. This represented a 1.1% monthly decline, but a 22.7% annual increase. However, when we adjust for inflation, margin debt is actually down 1.5% on a monthly basis and up only 18.7% compared to a year ago. So, at the suggestion of one of our readers, here we have the same chart as before, but we've inverted margin debt. In this chart, it's easier to see the relationship between the two series as a divergence. Our next chart here shows the growth of the two data series from 1997. Again, this is based on inflation-adjusted data. From 1997 to the late summer of 2000, margin debt and the market grew at comparable rates. Then margin debt soared into the stratosphere. In early 2001, the two were synchronized again with their rate of contraction. During the tech crash recovery, margin debt gradually returned to a growth rate similar to the one it had in the late 90s, but meanwhile, the real growth for the S&P 500 was a little bit more restrained. By September 2006, margin debt again went ballistic, finally peaking in the summer of 2000. 3 months later, the market peaked. Now, I want to stop because I hope by now you've noticed that throughout our timeline, we've seen a pattern emerge. Margin debt peaks are soon followed by market peaks. Most recent evidence of this was in 2021 when the margin debt peaked in October and the market followed 2 months later in December. Again, I want to note that we are using real inflation adjusted data. Lance Roberts of Real Investment Advice analyzes margin debt in the larger context that includes free cash accounts and credit balances in margin accounts. Essentially, he calculates the credit balance by adding free credit cash accounts and credit balances in margin accounts, and then subtracting margin debt. This next chart here illustrates all of that math of credit balance and overlays it with the S&P 500. Unlike the previous charts, this one here is based on nominal data and is not adjusted for inflation. So here's a slightly closer look at the data starting in 1995. I've inverted the investor credit monthly data and used markers to pinpoint key turning points. Again, with the inversion, it's easier to see the relationship between investor credit and the market. To close out, I'd like to note that margin debt data is several weeks old when it's published, so a major shift in margin debt is not immediately evident. Additionally, there are still too few peak trough episodes in this overlay series to take the latest data as a leading indicator of a major sell-off in U.S. equities. With all that being said, this is still an interesting indicator to watch and will certainly continue to bear close watching in the future. That's all for our discussion on the latest margin debt data. Thanks for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.